Now, this is a deep contraction, but it's likely to get worse in the second quarter, right?
So right now, our expectation is that year-on-year will probably decelerate further. In fact, we're expecting second quarter to decline 6.5% year-on-year. And this is predicated on the view that we have seen an escalation in COVID cases in Europe and US, and hence global demand will probably weaken further, and that will weigh on the economy like Singapore.
The question really is how much more the government can do. We've seen the first stimulus. The second stimulus is expected. The government will dip into reserves. How big must the stimulus be to provide that support?
I think the reality is when we think about policy support, I don't think policy support can fully offset the growth impact from what is caused by a public health challenge. What policy support can do is to limit the fallout and prevent things from getting worse, which is what a lot of central banks, not only in Singapore, but across Asia is trying to do. So if you look at the nature of policy easing, it's all about helping those most impacted sectors, either via policy financing, concessionary loans, or giving tax rebates to impacted corporates and providing wage subsidies. So I think a lot of these measures will continue to go on, but we don't expect this to frankly drive a growth turnaround. It will only prevent things from getting worse. A growth turnaround can only happen with the containment of the COVID-19 situation.
Deyi, let's talk a little more about of the stimulus measures. You mentioned MAS. I mean, they're kind of bringing forward this meeting for next Monday now. Most of the time we were expecting April, October. Is that a big sign of what sort of bold moves we could see from the central bank?
So yes, we do expect a simultaneous easing, and in fact, what MAS has done with bringing forward the meetings, that's not unlike what other DM and EM central banks in Asia have done. So we've seen the Fed doing an emergency cut. We have seen several Asian central banks brought forward their policy meeting. So for MAS, we are expecting them to bring the appreciation slope to zero, so they will flatten the slope. At the same time, they will recenter lower the midpoint of the policy band to the prevailing level of near. So they will be taking two steps at the same time. And this will be unprecedented in terms of double-step easing if you look at the history of MAS policy moves.
You mentioned about how EM Asia itself is, of course, a victim to the external picture that we're seeing when it comes to this coronavirus outbreak. The dollar liquidity issues is certainly one thing that they have to contend with as well. But some of these EM economies, they have ample FX reserves, they have regional swap lines, they have current account surpluses. To what extent are they actually sheltered from some of the dollar liquidity issues?
So I think overall the situation for Asia is probably still manageable. But maybe let me put it this way. What has initially started off as a public health challenge has led to a credit crunch. There will be some economies whereby your external debt to FX reserve ratio is not as favorable. You're dependent on external funding. So some of these economies will see stress. But overall, I don't think we are looking for an extended credit crunch situation in Asia. And just bear in mind, and as you have mentioned, DM central banks have been quite aggressive in terms of improving the funding situation. They can't control the COVID situation, but they can definitely alleviate funding stress. So we've seen a lot of measures undertaken by the Fed, not only bringing policy rates to the zero lower bound, but also undertaking unconstrained QE, putting into place a commercial paper funding facility. So all of these have helped financial conditions to improve since last week. And of course, not forgetting the FX swap lines, which is being done with BOK and MAS in Asia. So I think all of these are factors which will help. The other silver lining I will also highlight for Asia is that if you look at the dependence on credit markets, compared to Europe and US, Asia generally is not as dependent. So, for example, in China, 85% of lending is from banks. In Asia, ex-Japan, ex-China, about 2/3 of lending is from banks. So only a smaller portion is from credit markets. And where there is dependence on credit markets, the US dollar funding has gotten lesser over the past few years because of the experience from Asia financial crisis, whereby they were really hurt by the currency depreciation. So I would say generally so far, we are not expecting extended credit crunch to be a significant headwind for Asia region at this point in time.
Deyi, you mentioned the BOK. In fact, the BOK came out today saying that it will provide unlimited liquidity for at least the next 3 months. And it also came out to say that, you know what, it's not too wrong to call this QE. Was this a surprise move?
So actually, I wouldn't say that this is a surprise move. In fact, I mean, over the past few days, they've announced measures to provide liquidity to the markets in terms of a bond fund and an equity market fund. And earlier on, they were also expanding the intermediated lending facility to commercial banks by 5 trillion Korean won. So all of these have been leading steps. And actually, if you think about Korea, the thing is, if you think about it from a conventional policy tools perspective, they frankly don't have too much space on that front left. Policy rate is already at a low at 0.75%. Inflation is also very low, and we have the added disinflationary impact from oil, which means that BOK will have a challenge to take real rates lower, given all these circumstances that I've mentioned to you. So the other resort that they can rely on is to turn to unconventional measures like QE, or adopt more liquidity measures, or rely on fiscal to do the heavy lifting, which they have already done so far.
Deyi, before we let you go, just to touch on Indonesia, the rupiah has been smacked, investors pulling out from the debt market, and some say that Indonesia has been too slow in implementing stimulus which are not even targeted. Your views on that?
So I think Indonesia faces a challenge of needing to balance growth versus managing macro stability risk. And I think your point on stimulus is really pertaining to what's happening on the fiscal side, because frankly, fiscal policy in this circumstance today is probably more effective compared to monetary policy. But in the case of Indonesia, they do have a 3% fiscal deficit ceiling, and that is what has constrained them from doing more. And the reason why they have a fiscal deficit ceiling is because they run a current account deficit. So how do you manage providing growth support versus being challenged on the external funding front? So I think that is the delicate balance that Indonesia policymakers are having to deal with right now.